Good evening, everyone. So let's take a look at markets today. We had some strength, a little bit of strength lately in growth. We had financials act okay, banks a little bit. We had still a little bit of weakness as we see money roll back into growth and some of those momentum names, and then out of those consumer staples and some of the things that have been a little bit more defensive, healthcare, biotechnology, utilities, things like that. A little bit into mining. We saw gold and silver start to push higher. Silver starting to look really interesting. We'll look at that chart in a moment. Retail coming off, though, not coming back, still suffering from the growth scare blues. So let's take a look. So we had CPI today was a little bit weak, which kind of initially gave us that pop and then drop, the usual, getting these pops and drops a lot because there's just so much stock for sale. There's so much pain on those charts, so much destruction that it's going to be very difficult to kind of maintain that. I do feel, as I'm going to talk about in a moment, I do feel that we could have a significant squeeze to the upside. Things have gotten so bearish. And a lot of the CTA vol target flows, some of those big flows that have been in there applying pressure to the downside have dissipated to some extent. We're going to look at a couple of things that give us that indication. So let's take a look at Tesla. Interesting. It really got completely clobbered from 480 all the way down to 220. I picked some up just above 220 the other day. I normally don't get it that right, but we'll see. I kind of feel like it's the moonshot stock out there. It's got the guy, it's got the influence, it's got the power, it's got the access to funds. I mean, it really has everything. This is not a car company to me. I couldn't care less about Tesla cars. This is about creating something amazing from, controversial guy, but still pretty amazing. So, we'll see what happens there. It is a trader's market, so I wouldn't be surprised if we get up into that sort of 255 range, pull back a little bit. It'll be decision time. Do I kind of play this for a trade and accept that it can come back and retest that 220, or do I kind of stick it out and really play for something a little bit longer term? Certainly isn't the market to expect something to get too extended to the upside, so we'll have to cross that bridge when we come to it. Here's Apple really losing its kind of safe haven status in a sense. I mean, look at that. This is a stock that even I've mentioned is kind of like a bank account. People just want to plow their money into that. Amazing, eh? Warren Buffett, I don't know what his average sale price was lately, but he really nailed this. I mean, Buffett nailed it. I don't know if he saw tariffs coming, but his move into significant cash lately is epic. Walmart here completely falling off a cliff. I mean, 105 down to the mid 80s. I mean, this is just a complete disaster, demand destruction. You'd think Walmart could do well if we're heading into some sort of soft economic period, a recession, possibly at some point. This is a stock that can do okay, but really they're not. They're just taking it out of any stocks that have had sort of parabolic moves. And safety has been, if you look at some of those safety stocks, they really have had parabolic moves, some of them. We're seeing people move out of some safe things, Coke, Pepsi, things like that, if I remember correctly. There's definitely destruction everywhere you look. Here's Walmart again, coming down to that 38 fib level. So that's actually probably not a bad place for a little bit of a trade. If we look, let's take a look at implied volatility. There you go, right here, historical versus implied. So in the gold, we've got implied volatility short-term, 30-day, and it's, of course, chugging back up as many levels of option pricing are chugging back up in many names these days. So definitely on the high side, and you can see that IV percentile. So percentile versus rank tells you versus the current implied volatility at the money, how much of the time have we been below that level in the past, and we're basically hitting like 100%. So we've almost, this is about as high as it gets for Walmart volatility. So really that's something, you could take something like that, and if you thought, well, this is kind of a safety play into a softening economy, they're obviously just pulling the ripcord on this stock for whatever reason. That's somewhere where you could maybe look at selling a downside put vertical, kind of what we call a put credit spread, a bull put credit spread. I would still use a put vertical as opposed to just selling an outright cash secured put, just because I don't know what this market is capable of. And I like to have that little extra piece of long gamma there, right? When things are moving around, I like trades that have several pieces, especially if, some of them are long gamma. That's where I'm going to get a little bit of a bump in implied volatility, a little bit of that Vega exposure. Not to say that you can't close some of the short legs. That can happen as well if it's a ratio spread, something like that. There's often something to play with. That's why I like multi-leg trades as well. But for a sort of typical premium harvesting strategy, I like that vertical. So I would sell something like an 82 put out maybe between 5 weeks, 6 weeks, and then buy something a bit lower, maybe $5 lower, and play for that 50% fib retracement as that lower point where you'd own that put. So you grab a little bit of premium on something like that. So that's not a bad play. Um, let's move on. S&P quarterly. So this is interesting. Let's see. Are we seeing a real regime change? Well, I think we are potentially. I mean, if you've been watching any of my videos, I've been alarmed pretty much this whole way down from about 600. I was a fierce bull up to that point, and then something just changed. Of course, policies, what's happening out there just changed, and you can't be afraid to kind of pivot. And so this is it. This is our new reality, and hopefully you've been following my videos and things like that and my tweets. But here, this is kind of a concerning quarterly bar here, very red bar that we haven't seen in a long time. Could this be the beginning of something like this, which was the 2022 bear market? Well, I mean, it certainly looks like it could. At the very least, maybe we come down to this 9 EMA as a minimum. That's going to get us down to about 5,200, and then potentially we've seen that in a bad market we can actually get down to the 20. This is going to be a 20 period quarterly moving average, so it conforms to whatever period you're looking at. So it's a 20, not a daily 20. It's a quarterly 20. So we could, it's not impossible. By the time we get there, it would take a bit of time. Remember that it takes time for the moving average to keep going. If it happened tomorrow, we'd get down to about 4,500, 4,600. But chances are it's going to take a little bit of time to happen. Maybe we ultimately get down to about 4,800. I don't think that's impossible. If this gets worse, if the economy keeps deteriorating, what's this market worth? What kind of multiple do you want to put on it? I think probably fair, based on, like a 260, 265 multiple, could be down around the 5,000 range. And then what do markets do? Well, they usually overshoot. When you've got sort of a number in mind, they like to overshoot to the upside and to the downside. So maybe that 4,800 isn't insane at this point. We'll talk a little bit more in a moment about where I'm seeing things, generally speaking. SPX weekly, so we've broken down on this trend line. We've come down to that 50-week EMA, and what looks like maybe some sort of support zone. I don't know how valid that is. Maybe we come in, and my kind of base scenario is that we do rally. We've got a lot of bearishness out there. We do rally because of some of the things that I talked about earlier, and I'll talk about in a moment. The CTA, the vol targeting, the levered ETFs are really done selling to some extent for the moment. So maybe we do get a little bounce back, and that could be our opportunity to hedge very, very hard and start to potentially play some downside, because this market probably has no business being up in that 58 to 6,000 level. I mean, that's just going to make it super expensive in the face of complete and utter chaos. Anything can happen, right? I've been doing this long enough that nothing really surprises me anymore, but it wouldn't make sense to me for us to get back to those levels. And if they do, I think that's an opportunity. And so here we are. I think it's shorter term, we could probably get up into that sort of, what is that, 5650 level, this sort of spot here that we bounced off of this one time, passing through this moving average just a little bit, and then maybe getting down to that lower trend if we really wanted to. I do think that's possible. We can see this MACD kind of with a positive unwind towards the top, towards the positive side of things. So could happen. Whereas over here, if you look at the S&P daily, I mean, we could rally here back up to the 200-day moving average. That's going to be a big challenge there. We can see the 9 crossing the 200 for what that's worth. Probably not a whole lot, but that's what is drawn in here is probably getting back to that 200-day and then resuming this very sort of bearish kind of momentum MACD breakdown. Let's take a look at the NASDAQ. This has got, probably a little bit more of a problem right here, although I'm starting to think that maybe there could be some refuge in maybe some growth stocks, those balance sheet heroes that I like to call them, fantastic businesses where there's still going to be lots of profit. Things are not really going to deteriorate too severely, I think, for some of those companies. I've been picking away at things like Meta. Even in tougher times, I think Meta kind of hoovers in all the business that maybe those secondary and tertiary kind of ad companies get. Everybody just wants to go to the best. Why bother? Go with the best. Go with Meta. So, something like Meta, I think Amazon does okay. I think there's some interesting plays out there in the growth area. You guys know my usual ones that I like, the Netflixes and the Costcos. Picked up some positions in Costco today. So here we are, XLK. This is mostly Microsoft and NVIDIA, I think, 40%. And so we've had a nice little bounce back, but I wouldn't throw a party yet. We get back to this 9-day EMA moving average. That could get us up to around 215, and then that's going to provide a little bit of overhead resistance. If we've gotten this quite wrong, then maybe we could get back up towards that 200-day, 222.5. So I'd be watching for those levels tomorrow. Here's your semiconductor index. Perfect touch here from back last August. Isn't that something? Interesting though, we did not get NVIDIA back towards $90. That's where NVIDIA was, $90 back in that August sell-off. Did not get down there. So NVIDIA performing very well. People are preferring to own the very, very best name, arguably the best name. I would say it probably is. Maybe, Broadcom's in there, but one of the very best names in the industry versus other ones. And it's showing NVIDIA trading up, I think, around 112, 113 right now. So well above those August lows. Here is, what do we got here? Nothing. Here's your Bitcoin coming down here and recovering, really kind of struggling though, hasn't it been lately? We've come back down to this 200-day moving average. I think it's in a little bit of trouble here, right? I don't see, this is a risk-off environment. Liquidity is disappearing. And so that's not great. Bitcoin is just levered NASDAQ, right? It's levered stocks. So it's no more than that. At this point, it's just become kind of a little bit more mainstream. Once the BlackRocks and everybody starts owning it, well, it's risk on, risk off. So I think it's going to maybe struggle a little bit here with anything else that's struggling. And look at Ethereum. Man, we talked about this a couple weeks ago in one of my videos, and I said there's just too much competition for this thing. I don't know these things very well, but that's the word, is that there's just way too much competition in this kind of stable coin area. We thought Ethereum had the most utility of any of these kinds of coins. We can see that it's really, really underperforming. Look at this Ethereum. Where do I have that? There's an Ethereum. Oh, I don't have it on here, but maybe we'll come across it. Here's silver for you. We have it starting to act well. Silver's one of those heartbreakers, a bit like XLE for me. There's a few things that I trade where I just kind of don't want to trade until there's really some sort of very substantial trend happening. Maybe something's developing here. Gold had a good day as well. So maybe once we get through here, but even then, I want to see 35.5. Then maybe we kind of get excited about a little bit of a squeeze to the upside. Here's the junior gold stocks starting to act interestingly. If we can get above this line here, then maybe it's worth getting in here, maybe putting on one of my Vega play strategies, my Vega bailout, where you kind of put on, vol probably isn't super low, but you kind of put something on and you give yourself a big bailout if it completely fails from that Vega exposure. So I'd have to structure something like that a little bit closer to the time that happens. Here's one of the volatility metrics I like to look at. Very simple for people to set up. The vol index, which is the 9-day versus the VIX. So you got the 9-day versus the 30-day VIX, and what that gives you is a ratio that tends to show a little too much calm down in the 0.75 range and a little bit too much fear in the 1.2 to 1.3 range. So we've banged our head off that 1.2 number a number of times so far, which is a good sign for the bulls that it just can't get going too far past that. This was the problem we talked about a couple of weeks ago, and we said if we get through 5,800, all bets are off. And sure enough, we accelerated into that short gamma, short vega dealer profile. We can see now we've still, pretty good dealer imbalance. So I'm going to show you a few charts here that are maybe giving us a tale of a couple different stories here. So sorry to hedge, but this is sort of the reality as we kind of figure out which is sort of driving the bus here. We do have a significant amount of negative gamma. Here's that 55.65 huge short. That's the lower part of that JPM collar. Funny how we often get to that JPM collar strike. Typically we get to the call part of it because that's been a bull market. But this time we're down at the short leg of it because remember, this product owns a put spread. So this put spread here, it sells another one much, much lower. I think it's a 5 and 20. I think it does a 5 and 20 or something like that. 5%, 10% out of the money, something of that nature. And right now we're right at that strike. So this is substantial short gamma from a dealer's perspective that's going to increase as we get towards the end of March because the gamma, short gamma, is more pronounced the closer we get to expiry, as long as we're near that strike price, right? If we're way far away from the strike price, then yeah, technically there's more short gamma around the strike. But if we're too far from it, it doesn't really have much of an impact unless we start to get closer to it again. But as long as we stay around these levels, this is going to become a little bit of an upsetting the apple cart kind of effect and influence on markets. For a little while. Now, one positive is we've seen an improvement in the term structure for VIX futures, which is that front month minus the second month. So, of course, we're backwardated, which means that front. Here, I've got a version of that here. Here we go. We can see that front month is above the second month and above the third, above the fourth. So this is a very unhappy situation for markets, even with a decent action or not horrible action the last couple of days. We still see this sort of concerning area. This is a little bit older. The VIX has come down into that 24 range. So, but this has been an unhappy picture lately. We want to see something more like this, right? This happy contango kind of shape. So it's a bullish sign that we've seen a little bit of divergence, right? Positive divergence. We did not get, we bottomed on Tuesday, it says here. So it did not get worse, We did not get more steepness in that curve, which is a positive thing amongst other things. So this is what markets are dealing with, the U.S. economy today and where Trump wants us to be later, which is amazing. Wouldn't that be wonderful? The question is, what happens in the valley of death here? This period of difficulty that markets are certainly going to have a problem with. So levered AUM, which is mostly made up of technology names, a little bit more high beta stuff, semis, mag, etc. These are what these products typically are tied to, and so. Given that those are the products that have really had a very difficult time in markets, well, that's also adding to this synthetic gamma. But there's still kind of a little bit. This is a little bit older here. Basically, a lot of this has dried up a little bit. So as volatility comes down, we've had a few days of not too crazy close to close volatility. Some of the flows have been relaxing a little bit, the vol targeting, the CTA selling. So we're taking away, think of my cat in a room full of rocking chairs, we're taking away a few of those chairs. So the cat's starting to feel a little bit more comfortable with the environment because there aren't as many of those bogeys in the room, those rocking chairs. So it's starting to feel a little better. We can see that also the SPY versus the TLT, we've come down here. So that typically is a place that we bounce from. Look at this, 22, 20, even in here, we kept bouncing. We had that August debacle and pushed through a little, and now we're coming back towards there. So maybe a little bit of support there from a SPY versus TLT perspective. The TLT has been pretty tame. I'm glad I haven't been trading it because I don't have a good read on the long bond right now. And frankly, the 10-year has just kind of been sitting around as well. That yield's been sitting around, which is just fine with me. I think that's stable as well where it's at. If we start to see it drop below 410, then I think we've got some real problems again because the growth scare is going to be back in full force. So discretionary versus staples. Here we go. Discretionary had come down, and but at a certain point, this reverts. Do we need to get back down to these levels? Maybe at some point, but I certainly think there could be a little rally in this relationship before we continue downwards. Here's a little bit about Doge. Well, here's all the government jobs in green that have been created in the last couple of years, 2023, 2024. There you have it. Elon's taken the chainsaw to perhaps a good chunk of those. So a little bit of an unwind of Biden's big hiring spree in the government sector. So again, worth mentioning. Here's our bearish. We still have quite a few names that are still above the 50-day moving average. So from that perspective, you could say, well, that's pretty supportive, right? Even though we've had a big sell-off, we still have, stocks that are kind of hanging in there. Now, a true washout would probably entail a lot fewer stocks being above the 50-day moving average. So if we do get down into here, then that could be a better sign of the sell-off being done. But for now, there's still room down there. So depending on how you look at it, I mean, there's still room to the downside. Although you might take the tack that this is a moment to be a little bit less bearish because look, we have our AII sentiment as low as it was in the bear market of 2022. So people have gotten very, very negative indeed. And let's look a little bit more below the hood here. We've got this VIX Vega starting to relax again. That's a good sign, right? So this is a relaxation in the broader volatility complex, which I would say is like S&P index and the VIX, right? Those things would be considered kind of the broader measures of what's happening out there from a fear perspective. And so we can see that Vega that they need to buy with a rise in volatility is less, right? So think of it this way, they're short upside VIX calls, which isn't good for them if there's more fear, and that makes the VIX tend to swing up more easily, which it hasn't been doing, but it swings up more easily the more nervous those dealers are. But right now we see that skew is actually starting to come in, which is a good sign. That's a relaxation of fear levels in the broader complex. And indeed, today we saw and yesterday we saw a relaxation at the fixed strike vol level. What that means is those out of the money puts and at the money's kind of, especially the out of the money's yesterday, really compressing a little bit. That's a good sign when the market was down a little bit and there was a compression in the VIX itself, partially because of a compression in those out of the money puts. That's a good sign. You don't want to see the opposite. You don't want out of the money skew in the S&P to be pushing up. That's a sign that people are nervous, and there could be fuel to the fire as the market starts to unravel to the downside. But in this case, a sign that things have maybe relaxed a little bit. So that's a good positive thing. So we're kind of adding up the positives, and they're starting to kind of become more meaningful, at least in the short term. I do feel that ultimately we could have a very, very big sell-off, but maybe we get a little bit of a rally in the meantime, which would be really great in order to kind of lighten up, add hedges, put on some bearish positions. We took off some QQQs, some VIX positions. Be nice to be able to kind of rehook some of those at better levels. Now, even though that broader VIX is kind of relaxing, the the individual name skew still remains very, very high, has come down a little bit, but not very much. That means people are still very much pushed out into those protective positions. They're still a little bit nervous. They have not been monetizing them. Whereas maybe in broader index, they've been monetizing some of that. So the vols are still pretty high in single name versus the broader market VIX. And that's interesting because it means that people are maybe still nervous. They don't want to get rid of those hedges. And it also means that the dealers are short those hedges. So could add fuel to the downside. Now, the other side of that coin is that the old saying, when they're focusing too much on the left tail, start to take a look at the right tail. So I think if we are in store for some sort of decent rally in the interim, just to unwind some of this extreme bearishness, oversold RSIs, that kind of thing that we have right now, there could be a nice squeeze in some of these growth names. So here's projection in the Mag 8. We could have some really big squeezes is what this is showing you. If we're up 3%, 5%, there could be quite a bit of fuel to the upside and from in those levered in those levered ETF positions. So the ones that we sometimes like to, well, we don't really like to trade those levered ones because they're trouble. I've done another video on that. They really should be something you either understand or you stay the heck away from. Those levered, especially 3-time products are just toxic. But if you're going to trade something like that, you may get a little bit of a nice swing higher potentially in some of these products, which could make some structures look interesting, maybe some risk reversals, selling some expensive downside put skew, pick up some upside cheaper call skew. Something like that might make some sense for a couple week trade or a week trade, 10-day trade. I don't know how long it's going to rally, but there could be an opportunity in there. So that's where we're at. I know that was a long video, but we covered an awful lot. And I hope you guys stay safe, trade well, invest well, stay out of trouble, and we will see you in the next video.